So the market just crashed and is already bouncing back like nothing happened. If you blinked, you missed it. If you panicked, you probably sold the bottom. And if you're sitting there thinking, wait, how are people making money during this? Then congrats, you're in the right video. Because today we're breaking down how to actually profit during a crash. Even if the crash is already recovering faster than your friend who just needs a soft landing after investing in Dogecoin. Not financial advice. Just fast-talking, insight-packed content designed to help you not donate your savings to hedge funds one panic click at a time. Let's break it down. 1. The fast crash of 2025. What happened? Alright, flashback to early April 2025. Everything's chill. AI stocks are the new crypto. Then boom, tariffs. Trump, in full economic warfare mode, announces 145% tariffs on Chinese EVs and tech components. Wall Street immediately spills its coffee. Tech stocks tank, indexes nosedive, and CNBC starts rolling out the crisis font. China retaliates hard. 125% tariffs on US imports, and worse, restrictions on rare earth mineral exports. That's code for, you like your phone? Good luck upgrading it. The S&P 500 drops over 6% in a single day. Semiconductor stocks go off a cliff. TikTok money gurus start live streaming from bunkers. But then, plot twist, both sides blink. Within 3 weeks, the US and China agree to a 90-day truce, and the market starts rebounding like it's trying to pretend it never freaked out. Bottom line, it wasn't a collapse. It was a headline-induced panic attack. And if you played it right, this wasn't a threat, it was a sale. But even with the rebound, most investors did what they do best, and that's next. 2. Most investors missed the rebound. Again. Let's be honest, retail investors have a terrible superpower. Buying high, selling low, and crying in between. When the market tanked, people bailed fast. Reddit was on fire, Twitter turned into a live therapy session, and the knee-jerk response was, get out before it gets worse. But the market didn't get worse, it got better. Fast. Within weeks, major indices were up 7 to 10%. If you stayed invested or kept buying, you were riding that recovery wave. If you sold, you just missed the year's gains trying to wait for confirmation. This always happens. People try to time the bottom and end up chasing the top. So how do you beat that cycle? You do what feels dumb in the moment, and that's where we're headed. 3. Keep buying. When it feels dumb, that's the point. When the market drops, your gut says, hide. But your long-term brain, it should be screaming, buy. Enter dollar cost averaging. The boring but brilliant strategy where you invest the same amount at regular intervals. Why? Because it removes emotion. It forces discipline. And during crashes, it automatically buys you more shares at cheaper prices. April's dip? Prime DCA real estate. If you kept investing, your cost basis dropped. Now with the rebound, you're up. It's like buying sneakers on sale. You don't cry that they were 30% off. You flex harder. Same logic here. Now let's talk about what you're buying, because not everything on sale is worth it. 4th, target quality. While it's discounted. During crashes, good companies get dragged down with the garbage. Think Apple, Microsoft, Nvidia. Their earnings didn't collapse. Their debt didn't balloon. They just got lumped in with the chaos. That's your moment. You're not just bargain hunting, you're value shopping. Strong balance sheet? Check. Solid cash flow? Double check. Industry dominance? Yes, please. This is how legends like Buffett and Burry do it. They don't panic buy. They cherry-pick bruised greatness. So when quality stocks dip 15 to 20% without any fundamental reason, you don't scroll past, you scoop. But even if you miss that scoop, there's a slick tax trick you should have pulled. 5. Did you tax loss harvest while it was hot? Welcome to the part where losing money can save you money legally. Tax loss harvesting equals selling losers to offset gains and lower your tax bill. You don't cry over that red number. You make it work for you. Say you held a tech ETF that dropped 15% in the crash. You sell it, take the loss, and buy a similar ETF. Not identical. Thanks, IRS. Congrats! You're back in the market, and your capital gains just got sliced. It's like using a bad date to get free dessert. Didn't go great, still got something sweet. Now let's talk rebalancing, because if your portfolio's a mess, this is cleanup time. 6. Reposition. Now, before the next wave, market crashes don't just tank your portfolio, they tilt it. Maybe tech dropped 30% while bonds barely flinched. Suddenly, your 60-40 portfolio looks more like 47-53 in a panic headache. Rebalancing is your friend. Sell what held up, buy what dropped. And yes, that means doing the exact opposite of what your lizard brain wants. Also, this is the perfect moment to upgrade your allocation. Maybe it's time to add more international, or throw in some gold, or look at dividend stocks that didn't flinch. Think of it like meal prep for your investments. Do it now and future. You eat's good, but why bother at all? Because long-term wealth isn't built in the good times. 7. Wealth is built in chaos, not calm. Here's a truth most people never internalize. The real money is made during the panic, not after it. The quiet, consistent investors who DCA'd during the dip, they're up. The ones who bought Microsoft when it dropped 18%, crushing it. The ones who did nothing, even better. They didn't panic, didn't sell, didn't lose sleep. They just stayed in the game. It's not timing the market, it's time in the market. Everyone wants to be Warren Buffett, until it's time to sit still while everyone else loses their minds. So let's prep now, because this roller coaster isn't stopping anytime soon. 8. Prepare now, because the next dip is always coming. This wasn't the crash, it was a stress test. And if you flinched, now's the time to build your strategy, not after the next free fall. Start with your emergency fund, recheck your allocations, and for the love of gains, automate your investing so you don't have to think when the world goes full meltdown again. Volatility is the new normal. If you're not ready for it, you're going to keep getting sucker punched. But if you build for it, you don't just survive dips, you profit from them. Closing. So, the market dropped, then bounced, fast. And while the headlines made it look like financial doomsday, you're now armed with the playbook. You understand the chaos, you see the patterns, you know when to buy, when to sit, and how to turn red candles into green gains. Smash that like button if you're done being scared of the next dip. Subscribe for more no BS investing content that's smart, fast, and maybe a little too caffeinated. And drop a comment. What was your power move during this crash? Buy? Sell? Watch Netflix and ignore it completely? This is Investiverse, where we don't ride the market, we drive it. This is Investiverse, where we don't fear market chaos, we monetize it.